Wealthy individuals and corporations often employ a variety of strategies to minimize their tax liabilities. While some methods are legal and involve taking advantage of existing tax laws, others may skirt the edges of legality or involve complex financial maneuvers. Here are 20 ways that rich people might use to avoid paying taxes. 1. Tax deductions and credits. Utilizing various deductions and credits, such as mortgage interest, charitable contributions, and business expenses, to reduce taxable income. 2. Offshore accounts. Placing money in offshore accounts or shell companies in tax havens to shield income from domestic taxes. 3. Tax-efficient investments. Investing in assets that generate tax-advantaged income, such as municipal bonds, which are often exempt from federal taxes. 4. Income shifting. Shifting income to family members in lower tax brackets, often through gifts or trusts, to reduce overall tax liability. 5. Capital gains. Taking advantage of lower tax rates on capital gains compared to ordinary income by investing in assets that appreciate in value. 6. Real estate investments. Using real estate investments to claim deductions for depreciation and other expenses, or using 1031 exchanges to defer taxes on property sales. 7. Business ownership. Structuring income through businesses, such as LLCs or S-Corp, which can provide opportunities for deductions and lower tax rates. 8. Tax loss harvesting. Selling investments at a loss to offset gains and reduce taxable income. 9. Deferred compensation plans. Participating in deferred compensation plans that allow income to be received in future years when the individual may be in a lower tax bracket. 10. Retirement accounts. Contributing to tax-deferred retirement accounts like 401ks or IRAs, which reduce taxable income in the year of contribution. 11. Trusts. Establishing trusts to control how income is distributed and taxed, and to potentially reduce estate taxes. 12. Charitable contributions. Making significant donations to charities to take advantage of tax deductions and potentially establish donor-advised funds. 13. Tax credits. Claiming various tax credits, such as those for renewable energy investments or education expenses, to directly reduce tax liabilities. 14. Incorporating expenses. Deducting business-related expenses that may be partially personal, such as travel or home office expenses, by running them through a business entity. 15. Stock options. Utilizing stock options and other forms of equity compensation to benefit from favorable tax treatment on long-term capital gains. 16. Tax shelters. Investing in tax shelters, which are financial structures designed to reduce taxable income, although these can sometimes be controversial and subject to legal scrutiny. 17. Income splitting. Structuring financial arrangements to split income between different entities or individuals to reduce the overall tax rate. 18. Tax credits for investments. Claiming credits for investments in certain types of assets or businesses that offer tax incentives. 19. Relocation. Moving to states or countries with lower tax rates to reduce overall tax burden. 20. Philanthropic foundations. Creating private foundations to manage charitable giving while receiving significant tax benefits. It's important to note that while many of these strategies are legal, their use can sometimes prompt legal or ethical questions, and tax laws are subject to change. Consulting with tax professionals and legal advisors is crucial for navigating these strategies effectively and within the bounds of the law. Here are additional strategies that wealthy individuals might use to reduce their tax liabilities. 21. Deferred interest loans. Using loans with deferred interest to leverage investments without immediate tax implications. 22. Basis reduction. Utilizing techniques to reduce the tax basis of assets, thereby potentially lowering capital gains taxes when they are sold. 23. Family limited partnerships, FLPs. Creating FLPs to transfer assets to family members while potentially lowering estate and gift taxes. 24. Income averaging. taking advantage of income averaging methods to spread income over multiple years to reduce overall tax rates. 25. Alternative investments. Investing in alternative assets like art, collectibles, or cryptocurrencies that may have different tax treatments compared to traditional investments. 26. Tax-efficient fund strategies. Using tax-efficient mutual funds or ETFs that minimize taxable distributions to investors. 27. Use of debt. Leveraging investments by taking out loans to finance purchases, which can provide tax benefits through interest deductions. 28. Qualified opportunity zones. Investing in qualified opportunity zones to defer or potentially eliminate capital gains taxes. 29. Education savings accounts. Contributing to tax-advantaged education savings accounts, such as 529 plans, to benefit from tax-free growth and withdrawals. 30. Income exclusion strategies. Utilizing income exclusion provisions for certain types of income, like municipal bond interest or foreign earned income. 31. Amortization of intangibles. Amortizing intangible assets, like patents or trademarks, to spread the cost over time and reduce taxable income. 32. Tax-efficient withdrawal strategies. Strategically withdrawing funds from tax-deferred accounts in a way that minimizes tax impact over time. 33. Real estate investment trusts, REITs. Investing in REITs to receive income that is often treated favorably for tax purposes. 34. Health savings accounts, HSAs. Contributing to HSAs to benefit from tax-free contributions, growth, and withdrawals for qualified medical expenses. 35. Corporate tax shelters. Using corporate tax shelters and structures to take advantage of various tax breaks and deductions. 36. Specialized retirement plans. Establishing specialized retirement plans like defined benefit plans for higher contribution limits and tax deferral. 37. Intellectual property. Licensing intellectual property to generate income that may benefit from preferential tax treatment. 38. Estate freeze techniques. Employing estate freeze techniques, such as GRATs, grantor retained annuity trusts, to minimize estate and gift taxes on future appreciation. 39. Income splitting through partnerships. Forming partnerships and allocating income to partners in lower tax brackets to reduce overall tax burden. 40. Utilizing tax havens. Structuring complex transactions through tax haven jurisdictions to minimize tax liabilities, often involving multiple layers of companies and trusts. These methods illustrate the complexity and breadth of tax planning strategies that wealthy individuals might use. While many of these strategies are legal, they often require careful planning and professional guidance to ensure compliance with current tax laws and regulations. Enjoy your watching.